We're three past the hour. We still have some people filing in, but we have some excellent topics and equally excellent guests on our panel today. So I'll be the one keeping us on track for time, just making sure that we continue to have a spirited engagement around what might happen in 2026, knowing that in private markets, no one's really going to have that crystal ball. I'm Nick Fusco, CEO of PM Insights. We're a private markets data and analytics company. And today we're hosting Billy, Brian, Glenn, hopefully Idan, and Jim. So I've hit those alphabetically so we can kind of just go down the line. You can state your full name, company, and I assume a couple of you guys, since everyone's a broker-dealer here, will want to just put out a quick regulatory disclaimer. But I will note, if you don't, everyone has those regulatory disclaimers on their website, so go check them out. And I will pass it down to Billy.
All right, great. Thank you. Glad to be here. My name is Billy Brandreth. I'm the co-founder of Headwall Private Markets. We offer our securities through AGP Alliance Global Partners, a member of FINRA and SIPC. And Headwall and AGP are not affiliated companies.
Good stuff. Brian?
Yeah, Brian Kelley, Halberd Advisors. We are a white label firm on the FinX Capital platform, also FINRA registered. You can check out my website or the FinX website for all the appropriate disclosures.
Glenn?
Yeah, my name is Glen Anderson. I'm CEO of RainMaker Securities. We're an investment banking and FINRA registered firm located in Miami, Florida. And we're very active in the late stage private trading market, which is relevant to this discussion. Happy to answer any questions as we go along.
Great. And Glenn, we're passing it to Idan just for a quick intro of your firm name and where you're dialing in from.
Hi, Idan Miller, Unicorn Exchange. I'm currently in Miami. We're headquartered in Tel Aviv, Israel.
Great. And over to Jim.
My name is Jim Okun, founder and managing partner of Trest Capital, located in New York City area and San Francisco. Trest Capital is an advisory and trading group, which trading with broker-dealer securities of private growth companies, as well as advising companies on liquidity solutions. Trest Capital offers securities through Stonehaven as our registered broker-dealer, a member of FINRA and SIPC.
Excellent. So appreciate those intros. We expect to have a few hundred folks that have signed up. Hopefully we'll listen today live or over the next week or so. But it's a pretty good mix. We have everything from RIAs to VCs to banks and a whole plethora of Gmail accounts, which I mentioned we tried to go through, but couldn't really get to everybody to understand who the core audience is. But definitely in terms of numbers, it's very LP leaning, investor leaning audience that we have on today. So I think thematically we are going to hit on a lot of investment themes. And I figured, let's kick things off with Brian and start more macro, and given your background, Brian, in other OTC traded markets or just other markets in general, away from VC-backed secondaries, what are you seeing as changing in this market that is making it look a little bit more comfortable to investors that have access to those other markets historically?
Sure. No, I kind of look at just kind of where the flows are. I kind of look at that, within public markets as well. And I think in 2025, there was just a big contraction in terms of the pure, private equity dollars and real estate dollars that came into private markets and alternatives as a whole. And that's more so as a result of kind of where rates were. So, I think given the increase in attention to the late stage VC market, that was kind of one of the lone bright spots in terms of just overall fundraising. So a lot of that money was put to work over the last year. I think you saw the IPO market starting to soften a little bit. I think there's somewhere in the neighborhood of 60 or 70 companies that are set to go or expected to go in 2026. So I would expect the strength, especially in the late stage, VC-backed companies to continue. Anything really levered to all the trends we're seeing in and around AI, even to some degree fintech as well. I'd expect that strength to continue. And, to the extent we get, the Fed to cut rates here over the next, 3 to 6 months, I think you probably see a little bit of a comeback in real estate and real assets to a degree. And so maybe there's a little bit more, competition in terms of where the dollars are going. But, overall, as I kind of, think about the flows and look at, the mega funds that were raised in 2000 or 2020 to 2000, really 23, there's still a lot of dry powder out there that needs to, be put to work. And there's a lot of very, very mature, late stage, private companies that, quite frankly, would have been public 10, 15, 20 years ago at this point. But just given the access to the capital markets, they elect to stay private, and that, I think will allow, that this market to continue to do well here into 2026.
Great. And I know, Billy, you and I were talking in the last week about that comparison between the public and the private. Things like rates are going to impact both markets. But when Brian's talking about AI, I always start to think, okay, what's the pure play AI company that's public? And nothing really comes to mind. So given your background, having a couple decades in the public markets and then moving over to private, I mean, what are you seeing I mean, should everybody follow suit, and start having exposure in private markets? Or, what are the major similarities that actually might play out in 2026?
Well, I think to Brian's point, with these companies staying private longer, a lot of that growth is happening in that 10-year period when they're private. So those more publicly focused funds need to get into the private markets or want to get in the private markets to capture that growth. So,
Right.
and I think as this market, think about it, the private markets is still fairly young in its life cycle compared to public markets. So as it continues to mature and have little changes occur to it that we can talk about endlessly, but I think it's becoming a more investable market for retail and institutional investors. And as that continues to happen, I think we'll see a lot more activity in our market. And it's really just validating to the marketplace overall. And I do believe that, with the liquidity concerns that have been out there since 2021, and again, as Brian mentioned, as we start to see the IPO markets open and liquidity starts to come, that those companies that can take advantage of the public market will. But at the same time, I think we still have a lot of companies growing into their valuations for 21. Could also be the delay for a lot of companies not going public. But as they start to occur, maybe 10 years from now, the window to go to public shrinks back down to 8 years. So again, it's just the appetite of investors. It's different from I mean, I think there's a lot of people who think the public markets are a lot like the private markets, but they're very different. I think they're more cousins than siblings in that way. So, but they're different for their own reasons. And, much like real estate's it's an investable market, but it's not necessarily tradable. You have some assets that have great valuations, but they might be hard to get liquidity. But the private markets, there are great ways to get liquidity in it. I think it's still, a lot of people are still learning that, whether it's retail and institutional, understanding that there's still great ways to get liquidity in this market, more so than they think.
Right. And I mean, a lot of what we go through is at the institutional level, which is again very different than the retail level here. I mean, maybe does someone want to pick up that difference between doing a $50,000 trade and a $5 million trade in the private markets?
Yeah, I mean, I'm happy. I mean,
Sure, go for it. Yeah.
Yeah, so at Headwall, we work on all size deals. We're more geared towards institutional, but we can work on any size. I mean, at the end of the day, our saying is every trade is different. Every deal is different. There's no uniform way of any deal is going to happen from beginning to end. Clearly, the larger deals that you do, a lot of times there might be more information available about those opportunity sets because of the size of them, clearly. And the negotiations or the due diligence on those deals have to take a lot longer than doing smaller retail-driven trades. So at the end of the day, the negotiations are kind of the same, but at the same time, the way of going about them is how we do it is the bigger the trade, the more sensitive it is, if that makes sense, right? So in the private markets, all trades matter, all trades are sensitive, but the most sensitive part of a transaction is an institutional investor selling. And along with that comes a lot of responsibility to be able to handle that type of transaction. So that is kind of that is a big difference, at least that we see. I'm sure other people have other comments and opinions.
Right. And Idan, maybe I'll point the next one to you because it's kind of an extension of what Billy's touching on here. But there are quite a few differences when you're looking at the makeup of a new investor coming to the market and they want to better understand, what's the correlation in some of these names that I may take exposure to. So everyone is a little bit different, as Billy's saying. What's the volatility? Because I think a lot of people don't spot that there is volatility in this market because the price isn't necessarily just the last round price, right? When we're doing secondaries. And then, I mean, with that, what is the liquidity today? Is it one-sided, two-sided? And what will it be like in the future when maybe I want to unwind a position? Um, but maybe you could speak on some of those attributes of a trade in the private market, Idan.
Yeah, so we're mainly focused on the institutional side of things. Our minimum trade on our platform is $500,000, and the average trade volume is about $6 million, which means that the majority of our buyers and sellers are institutionals. So we're less focused on retail investors coming into the space. When institutionals are playing in the market, they usually have good sense of where the market is at any given time, price-wise, sentiment-wise, structure-wise. There's difference between different companies in the way that they see secondaries. Some will open their books to secondaries easily, but there are more and more companies that restrict different types of secondaries. But when institutional players are playing in the market, they usually understand where the market is at for these different names. Volatility-wise, we've seen a pretty one-side road from, let's say, mid 2023 after the market correction in 22 and the first half of 23, maybe the first three quarter of 23. So from the fourth quarter of 23 and up till now, I think we're seeing in most of the names, and of course there's differentiation between different companies, but most of the names are moving up on price pretty constantly. I think the AI boom and as you said before, most of the AI companies, maybe apart from Google, which is not considered to be an AI company, but is probably the largest AI company in the world. Apart from Google, all the other AI companies are playing within our space in the private market because they're not public yet. The boom of the AI have driven the market pretty significantly up in the last couple of years. We're seeing uptrend that goes from 10 billion to 20 billion to 50 billion to 100 billion in a matter of a few months, maybe a couple of years, in many of the names. Here and there, you see companies that are moving downside in pricing, but I would say that the 95% of the market in the last 2 years or 2.5 years are moving up.
Yeah, absolutely. And I don't think that's the .com and appending a .ai to the end of your company name that's the phenomenon here. I think there's really some incredible technological advancements in that every one of us on this call is deploying AI in some way, shape, or form on our sides. I don't think we're going to change our branding anytime soon. But that's good to point out. And I do have some stats that I'll hit on later about, how far AI has come in the last year just for company performance. But I mean, Glenn, you've been in this market probably longer than anybody. And let's say that you do have a new institutional investor, RIA, family office, someone that's coming to market with 1 to 5 million. Considering, all those aspects of correlation, volatility, liquidity, what are some of the things that you want that investor to ask themselves maybe before coming to market to get an understanding of, is this an asset class for me? How do you prep someone?
Yeah, I mean, as was pointed out by others on this call earlier, private markets and public markets. I think the quote that they're cousins, not siblings, is probably a good description of what happens in the private markets versus the public markets. And the biggest problem with private markets is liquidity. Um, you buy a stock and you pretty much need to expect to buy and hold because sometimes it can be very difficult to get out of that position in any any timeline you would normally expect from other markets. It's illiquidity, and there is, to Idan's point, the market has been on a trajectory of up and to the right for now 2 years, maybe a little bit more. But corrections do happen. I've been doing this for 15 years, and in 15 years, I've seen the ups and downs of the market, and private markets do correct. I mean, we're kind of spoiled right now, and the prices just seem to be going up and to the right. But these markets do correct. Private markets do correct, and there was a big correction in 21 and 22, which everybody's familiar with, probably on this call who's listening to this call. So, what I would say to investors is don't expect liquidity, know that there's risk, and know that these companies aren't necessarily as developed as a stock they might buy in the public market. I mean, there's more risk. These are smaller companies in their growth stages, and they can win big or they can get out innovated and go nowhere. So, just understand what market you're participating in and the nuances of that market.
Right.
Yeah, I would actually add to that. I think a lot of these companies, like Glenn said, they're just not as further along, and to that point, the infrastructure within these companies isn't as built up, and the governance isn't quite there relative to a public company. So that's another reason why they are very much different in a lot of ways.
Right. And I think that governance brings us into the next point. You can't just go to your trading platform and immediately buy or sell one of these companies and it's done, in less than 1 second, right? If we wanted to buy Google or Ford Motor Company, any of those, we can get that done in a fraction of a second. Um, but I also wonder how this market will evolve. If it's cousins with other OTC markets like municipal bonds or syndicated loans, it takes time to make a trade happen. And also, when you're working with the issuer or not, or dealing with SPVs or not, um, it is a very, very different animal. So maybe I'll hit this to Jim so we keep passing the puck. But how is this market potentially evolving, or how are we able to find access in 2026 that maybe wasn't the case in 2020, or what might be the difference in 2030? Do you think everything's gonna go on one exchange? I kind of doubt it. That's why you guys are all so important, I feel. But Jim, yeah, any thoughts you can have on that and how the trading strategy or access strategy might be changing?
Yeah, so I think everyone here knows the SPV phenomenon that we're dealing with the past 12 to 18 months. I've seen massive upticks. I'm sure we all have, where almost like a pay to play with getting access to a primary. And then there's, an SPV with a 10% one-time fee, which is now seems like market, with not much flexibility, maybe to 8%. Some people are putting carry on that. We're getting double layer, some triple layer SPVs of people trying to retrade things. So I think that's probably the first thing I've noticed from, 2020, let's say. And I think that plays into, where we all need to adjust and understanding where that supply is coming from to kind of source as we work through our buyers and other people in the network. So that's probably the first thing that I've noticed for what's changed the most. And then outside of that, longer term, I think a lot of people have tried to make decentralized platform and making everything, electronic with using technology to do this trading. But to your point, I think that's the reason why we all do what we do and will continue to do what we do. I don't think that will be the case. It's very fragmented. Everybody's starting a platform to do trading, and I think it's whether it's walled garden or not is kind of up to that platform on how they want to handle it. But I think it's working with partners, working with folks here on the call to find good supply that's real is more important because I think anybody could post something on a platform and there's really no validity behind it. I think to a lot of point of other people here, there's sensitivity with the institutional side of things. They're not. That's why I think other platforms haven't taken off as they thought, because the institutions aren't comfortable posting their orders on a platform, whether it's a dark pool or not. They just don't want any type of noise of a $50 million seller of a company on any platform. So, which I think goes to the discretion and confidentiality, which is why we all do what we do and why we're good at what we do. So, I think that probably won't happen. So I agree with you, Nick. And I think, understanding the issuer and the governance and things we've talked about is important with the companies, and kind of knowing the lay of the land will help facilitate transactions, hopefully through everyone here on the call.
Sure. And I don't want to just make the assumption that whoever is dialed in understands the full complexity of a triple layer SPV with carry on 2 layers or something like that. Does someone want to talk maybe about the evolution of how, we got here over the last couple of years and what an SPV is all about? I'll just give that to the floor.
Yeah, I want to add to what Jim said. When we started 6 years ago, and Glen probably have more history to share, about 85% of the trades we've done in the first 3 years were direct trades. And only 20% were SPVs trade.
And just to chime
Nowadays,
in for clarity, direct meaning the investors
direct
getting
shares,
access to
shares
be
that are
on
moving
the cap
hands.
table themselves of that company.
Yeah, exactly.
Right.
Nowadays, we're seeing the opposite. 75 to 80% of the trades in the last year and a half are SPV trades. Single layer, double layer, sometimes triple layer, with all the complexity. One of the main reasons is that more and more of the demand is coming into the main 10 to 15 companies. And these companies control their cap table very, very thoroughly. They're not allowing any newcomers unless they're friends of the founders or the CFO. And therefore, most of the demand that's coming into the market has to find ways which are not direct on the cap table opportunities. And therefore, there are more and more LP trades in single layer. And then if you can't get into a single layer, you're getting into a double layer. And if you cannot get into a double layer, you're getting into triple layer. And of course, the risk associated with a triple layer SPV is very high because the transparency of the ownership of the shares between the first layer to the second layer to the third layer is always very, very problematic. But since people are not being able to get onto OpenAI or XAI or Anthropic any other way, there are people who are ready to do these triple layer SPVs as LPs. So I think one of the main phenomenon is moving from direct trades into LP trades. The second one is the concentration of demand on fewer names. When we started 6 years ago, at any given time, we saw demand for like 80 to 100 names. I'm not saying that we closed trades in all of these 80 to 100 names, but right now we're seeing demand mainly for 15 to 20 companies. Here and there, you see some demand to other companies, but 90% of the demand is streaming to the decatrons of the world and $100 billion worth of companies, which didn't happen 6 years ago. So the combination of the two, I think, will drive more and more of the volume into these LP trades with all the problematic of these LP trades.
Right.
I completely agree with Idan on this. And, as I've gone through my career in this business, the market has evolved and SPVs have become a much bigger factor in our marketplace. And I mean, I don't have a lot to add because Idan hit the nail on the head, which is it's a function of a few things, but mostly a contracting pool of opportunities that form the bulk of the demand in the marketplace. Think AI names. Um, there's what we see on our platform is consistent with that. Maybe 20 companies that actively trade on a frequent basis. Other names do trade, but on a frequent basis, 15, 20 names. Yeah.
Right. And I will say, because I mean, we sit independently of every broker, right? And we've seen that similar trend go from majority direct SPVs more and more, that coming through. And I think what's really interesting for us here as a data provider is how we can visualize that trend over many, many years. So if we have 5 years of data on this that's somewhat reliable, how are we seeing things trend from a bid offer spread component? So we've had bid offer spreads actually contract to around, 6 to 10%, depending on if it's these liquid names to less liquid names. So that's down considerably from 12 months ago, which is great. We're seeing a leveling off of your bid. For every one bid, there are about two offers on what we're seeing right now, and that's usually a pretty reasonable middle ground for homeostasis, if you will. But then everybody's kind of touched on AI, and just to give that headline number why AI was so important. AI as a sector, from what we're tracking or tagging as AI focused companies, is up 140% year to date. So that's versus about 67% for 50 of the most active names. So when you're having a double or almost triple of that, it's pretty impressive. And that's kind of driving also revenue multiples, which are at a multi-year high of some in most cases like 55x on a exact average. So with that, I'm gonna send this one back to Glenn, just as he's been in this market longer than everybody. Is there a place for more time series data index benchmarks out there? Because public market investors kind of demand it, or why are we seeing more demand for products that are showing a time series?
As in the types of data that PM Insights provides.
It could really be anyone, but I just hit on some of those stats, understanding where we're at in terms of a trend of bid offer spread, understanding where we're at for the relationship between sectors like financial focused companies, data focused companies, AI focused companies, because, 5, 10 years ago, a lot of the data was point in time. So when you're talking to an investor and they're coming from the public market, but they're decently versed in private, is more timely information the most important factor? Or when they're looking at a company, are they saying, oh, geez, I really love the founder. I really love the CEO, the C-suite. Or am I getting an attractive price relative to its peers in terms of revenue multiple? It really could be anything, but I'm curious of how daily time series is impactful in today's market, or
Yeah. Look,
if that's changed at all.
I'll put it this way, Nick. When you came to me, what's it been, 5 years for PM Insights now?
Right.
When you came to me 5 years ago with this concept, it took me a while for the light bulb to go off, but once you explained it thoroughly, um, what you were looking to accomplish, I was immediately on board. And the reason is because one of the key problems in our market is just transparency. There's no centralized marketplace like there is for a public stock. And the bid offer spread on the types of stocks we trade can be 5, 10%, where it's fractions of a penny for a public equity.
Right.
So there's an appetite out there from investors for reliable data on where the market is. Rather than call up 100 brokers themselves, if they can go to PM Insights and get that data, I think there's demand for that. And that's why we've been a contributor the last 5 years. We believe in what you're doing and how important it will be for this market. Because even large platforms, I mean, the large trading platforms like a Forge or a Hive, even just going to those two sources, they claim to have a deep market on their platform, but the difference between the two platforms can be huge. We've seen it when we've looked at their data. So you have to have a broad you have to be able to assess, a significant portion, enough portion of the market, a statistically significant enough portion of the market to really get a sense for where the market actually is.
Right. And you bring up a good point looking at what's occurring with Ford acquired by Charles Schwab, Goldman Sachs intervening with Industry Ventures, EquityZen being acquired by Morgan Stanley. Clearly, the biggest infrastructure or institutional players around are getting involved. So maybe I'll boot this to Brian. Do you think this is going to ultimately change the landscape? The fact that you're having more of the bulge bracket banks getting much more deeply involved into our market specifically. Well, the answer is yes, but like, how do you
Yeah,
think it'll
the answer's
evolve? Yeah,
clearly
that's
yes,
it.
right?
That's
Yeah,
an easy one.
and I think Caplite is kind of the lone player out there without a counterpart yet. But maybe J.P. Morgan or somebody else is taking a look at them. But no, listen, I think I think Glenn hit the nail on the head, and I kind of you look at this as an OTC market, and I used to trade in the bond markets. And I heard stories, about 15, 20 years ago about, spreads that were, at one point there, especially, within high yield that tightened, and tightened even further, to the point when I was working in it, there was trace, and nothing really deviated much more than than a teeny or a quarter of a point, where I think every trade, 5 years prior to that, everyone was at least a half a point, to be made. So, my view is what you guys are doing is mission critical in terms of just our work and just the growth in and of itself of private markets, because the buy and hold strategy, it's not really a risk management strategy, right? So you're going to have more of a market where LPs can kind of come in and out, maybe not come in and out, but essentially get out of a position or take exposure down. In the case of SpaceX, there's a lot of deep money in there that's been in there for well over a decade. That if you look at a pension fund that has liquidity needs, or you look at even an employee that's going to have liquidity needs as they got to send a kid off to college or meet some medical expense, there's just going to be really needs to be an infrastructure in place to value these companies and price these companies accordingly so that more transactions can get done.
Right. And with that, you have two major themes. Okay, so 401k access, the executive order that's trying to place more people in these potentially illiquid but high return type assets, and then just general landscape of the global wealth transfer. I don't know, Billy, are you starting to see some benefits to that, people preparing for those events? Or is there anything that we should be considering for 2026, 2027, or beyond for like a reallocation across asset classes?
Well, I think to the point you mentioned of the acquisitions that we've seen, that those are all mostly wealth management, retail-driven acquisitions. So that is clearly a huge part of our investment, where investment dollars are held, is in private wealth, in the retail sector. So we all know that some of the big bulge brackets have tried to get into institutional size transactions in privates, and they really haven't they've come in and come out. Maybe they'll come back again, but clearly the motive right now is to get into to that retail sector. And I think, again, that just validates the whole marketplace in general. And then I think, again, as we're all registered, FINRA representatives, the transparency and the fiduciary responsibilities of all those types of investments for the retail sector is also what makes PMI so important, because there's going to have to be a mark to market. And I think the more this private market moves to a mark to market kind of model in a way, because that's what large institutional investors are used to. Again, that's only going to make the market more mature and more likely for those people to continue to play in. So I think there's two things going on. You have clearly the wealth management channel who wants this, and they're very hungry for it. And the SPV environment that we live in kind of can make it not so great for them sometimes. But at the same time, we also know some of these I mean, we're all aware of that some of the big wealth management channels are getting their own access to these deals and selling it into their channel already. So that could be a shift that we might see less of that come through our channel, and it's going to go through more the RA channel as those continue to grow. But I think overall that everything that we're seeing, along with what PMI is doing, and again, this dimension, it's the quality of the inputs that you're getting and the model behind it is what is so good, right? Because I think it's something maybe Glenn mentioned. You can't take if you have bad data input, you're going to get bad data output, and you can't have that, right? You have to know what's relevant to a certain to evaluation or price per share. And the more you can do that, and as you guys remain independent, right, you're non-conflicting with what everybody else is doing, I think is a huge part. And
Right.
I think that's why people want to contribute and want to see it continue to be a success because it benefits us all. And not just us, this group, but all the investors in the world out there who are watching and want to be part of this. It just becomes more transparent where that is better for everybody.
Well, we definitely appreciate the shout out. And I think, we did make the conscious decision as a business line to avoid retail as an input for data purposes. It doesn't matter if you're coming from the fixed income market and you're looking at an odd lot, you're not going to mark your book to it, right? So I guess, you know, for Jim or Idan, if you guys can comment on the ideas of what to expect as a retail player and what maybe you can expect for deal quality whether it's price discovery or best execution, when you move up from a $50,000 trade to, let's say, a $500,000 trade, are you getting better treatment? Because I always think the answer should be yes, but sometimes you can get a deal doing that odd lot. So I'm very curious on what you guys have to say on that.
I want to comment on the transparency issue before, if I may. I think if we look 5 years, where we've been 5 years ago and where we are today, I think the level of transparency in the market increased dramatically. It's true that not always the prices that you can see on Forge and Hive and Cuplight and other platform would be identical. But I think we're getting to the point where there's much more similarities and on their market estimated pricing, just because the flow of information they're sharing, everyone is sharing with each other bids and asks. They don't share who's the buyer and who's the seller, but they do share the fact that there is a buyer looking to buy SpaceX at 212 plus 8%. And the fact that everyone is sharing this bid and ask and sometimes close trade data gives everyone more ability to predict where pricing for many of these names are at any given time. And it gives the investors more data to understand where the market is at. When we started 6 years ago, the base for most of the data was what was the last round price of the
Right.
company. And in today's market, sometimes the last round price is completely irrelevant to where the pricing of a certain name is at this point in time. I think one of the reasons Morgan Stanley and Charles Schwab got into the market, and I think other banks will get into the market as well, is because the level of transparency increased, and the market is getting more and more ready to start absorbing retail investors. Of course, the banks need to play a role here. It's not that the retail investor will go into Forge or Hive and start buying a massive amount of supply directly. But when the big banks will offer the solution to their client base with different types of mediation that they will do to this data and supply, we will see more and more demand coming to the market from type of investor that were not involved in the market so far.
Yeah, I would say also, here's my opinion about the acquisitions of EquityZen and of Forge, and that is, I'm not worried about the bulge brackets from a competitive perspective, because here's the thing, and here's why every person on this webinar has a business, is because it's a very entrepreneurial business, and that's just not how the bulge brackets operate. So I don't see their entry as something that's keeping me up at night. I think they will get value out of the acquisitions, but I think a lot of their motivation was their wealth management business. Keep in mind when we get a early employee, $10 million worth of liquidity, then they're immediately looking for a money manager. So, we make millionaires every day in what we do by providing liquidity to these shareholders. And I think it's that flow of wealth management clients that made EquityZen and Forge, good acquisitions for these companies. Um, could I be wrong? Possibly, but again, it doesn't. The bulge brackets don't keep me up at night. I have other worries.
Love it. So we do have a bit of extra time for questions as well. So we're going to open up the Q&A piece and we'll see what comes in. All right. So the first question, what is the overall profile of the seller, in particularly a VC secondary seller? So let's say, Glenn, if not the particular person that's trying to sell from the company, not an early employee, it's actually a VC seller. What's that profile
Yeah.
sometimes look like?
Well, I mean, you said it. If it's an early investor that has been in the stock for 7, 8, 9 years, and they want to return capital to their LPs, they come to folks like us to help them do it. And the nice thing about those trades is usually they have approval to transfer. Um, if there are, I mean, look, let's face it. If you were an early VC investor or you're a senior executive at the company, your trades get approved. If you're a rank and file employee, it's different. But if you're an early VC investor, chances are you can get a trade done. And so we see that. I wouldn't say that VCs looking for liquidity is the largest part of our market at Rainmaker. We tend to be institutional for sure. Our average trade size is 5 to 10 million. Um, but it's not a huge portion of our business where it's a VC coming to us looking for liquidity. But it's definitely a part.
Great. Okay, we have someone who wishes to remain anonymous asking about something that we get asked pretty frequently. So I'll not opine, but I'll say we'd love to have the conversation in 2026. Does anyone want to take a stab at what's the potential or the pitfalls of tradable indices in our space? I will say silence might be the answer here. Would love to bring this up on a future call. Um, so that would be great though, because it's a very, very tricky
It's
subject.
it's in the future. Tradable indices. You mean like you would buy a private market indices like you might buy
Me
an
too.
ETF on the
Yes.
public markets? Is that where
I
the
think
question is
the
going?
the way I'm reading this question is actually tradable in terms of a hedging mechanism. So not like a fund that's tradable daily, but more of like something that could be shorted potentially.
Well, that's what I'm saying about the
In the time I've been doing this, I've actually seen some parties out there try to do this, try to create derivative products, for example, applying to the secondary market, chains apply to the secondary market, um, create so it's been attempted. We've been approached a few times
Right.
by players that were looking to do exactly this, but nothing has caught on. Nothing,
Yeah,
at
I
least that
mean,
I've seen, nothing has caught
yeah,
on.
to Glenn's point, the market's too illiquid to rebalance an index product at the end of the day, right? So it gets really complicated. I mean, I think even Caplite, when it's first started out, was trying to do a derivative product. So it didn't work out. It's not, again, that's where those things are. It's like, it might not just fit this type of market,
Right.
And I mean, there are others that have baskets of publicly, private companies that I think do list and then they trade this huge premium to net asset value. Okay, that's great, but you could probably go buy those same names in the private market, right? So you don't need to pay the huge premium of NAV. You can come to the private market and buy it. So it will move around.
Right. And
When
we'll take
when I
one
when I
more.
started got into the market like 8 years ago, I was part of a project that tried to tokenize the interest, the LP interest of an SPV with a unicorn block with it. Back then in 2017, 18, the regulation was completely against it. Nowadays, there are a few places in Europe, mainly UK and Switzerland, which support tokenized real assets. And there are a few projects that tries to tokenize assets like unicorn blocks. If it is successful, and it's still a question mark if it's going to be successful, there will be more liquidity option, and therefore there will be more derivatives product behind these liquidity products. But it's yet to be proven, and we'll see in the next couple of years if this tokenization element can create new type of assets in our market.
Right. So I think we have time for one more for the team. What is your view about the trend of private companies trying to prevent or limit secondary markets in their shares? For example, OpenAI. This could be taken that way, or the counterpoint to this is there going to be an obligation of these private companies to encourage activity through investor relations and additional transparency about their financials? So it kind of goes both ways if anyone wants to take that
Yeah.
crystal ball for 2026.
Yeah, I mean, I don't know if it's 26, it'll probably be further out, but I think the war for talent and providing employees liquidity is going to be an uptick, which is good for everybody. And I think we are on the other side, I think, seeing more restrictions, particularly with former employees,
Right.
where I think they need to unlock that a bit. And it's beneficial for the company, it's beneficial for the shareholder to get that liquidity. And I think it's kind of rising tides across the board with all of that. And I think companies need to, and we're seeing more tenders and things like that. We need more formalized processes through the issuer to allow more of these folks to get liquidity.
Yeah. I think Jim brought up a hugely important point, which is the war for talent. If you're a talented AI researcher and you know that if you go to XAI, you're going to have liquidity on your wealth, but if you go to OpenAI, you're not, it impacts your decision. I mean, despite just what I've always said, participating in this market, the lack of fairness of blocking an early employee, for example, from selling their shares when it's their wealth. They should be able to do what they want with it. But it's going to have the war for talent is going to have an influence on these kind of policies with private companies.
Fantastic. Well, we appreciate everyone for dialing in and the panelists. The expectation is we're going to do these quarterly. So 4 times a year, we're going to get an update on progress in the market throughout 2026, hopefully into 2027 beyond. But we appreciate everyone dialing in, the great questions, and we'll see everyone in 3 months. Thank you.
Awesome. Thank you.
Thank you very much.
Thanks, guys.
All right. Thank you.